All right, let's dive into an earnings report that really had Wall Street scratching its head. BLNK charging. I mean, this one was a doozy. They posted a huge miss on their earnings, but somehow the stock shot up almost 10%. How does that happen?
So that's the big question we're tackling today. How on earth does a company miss its profit targets by more than 50% and investors reward them with a nearly double-digit gain? It just doesn't seem to make sense, right? But clearly the market saw something else going on under the hood.
And just look at this. The contrast is absolutely wild. On one side of the screen, you've got this massive 50 to 60% miss on earnings per share. I mean, that's bad. But on the other side, a 9.56% pop in the stock price. This tells you right away the headline number was not the real story here.
To figure this out, we have to look past that big, ugly headline loss. Smart Money obviously dug into the details of the Q2 report, and what they found was a much more optimistic story taking shape. Okay, let's get into the actual numbers. Yeah, that EPS loss of 26 cents was way worse than the 17 cents everyone expected. No denying that. But, and this is a huge but, look at the revenue. $28.7 million, absolutely crushing the $25.2 million estimate. And it gets better. That's a 38% jump from the last quarter alone, and their service revenue soared 46% from last year. This is clue number one. The growth is on fire.
But even that amazing revenue beat wasn't the whole story. The real reason investors got so excited was a super decisive, three-part strategic pivot from management. This is what showed everyone there's a real plan to turn this ship around.
And here is that plan. It's clean, it's simple, and it's powerful. 1. Acquire a company to fill a major product gap. 2. Cut costs aggressively with the new initiative. And 3. Resolve a huge liability that was weighing down the company. Acquire, cut, and resolve. Investors love a clear, actionable game plan.
And you can really hear this new focus in the CEO's own words. Mike Boduyaga made it plain and simple. They're not just trying to sell chargers anymore, they're aiming to be the provider of choice. That's a huge signal they're shifting from just growing at all costs to being a strategic and hopefully profitable leader.
So let's talk about that first piece, the Zometric acquisition. This was brilliant. BLNK knew they had this critical gap, their words, for customers who are really price-sensitive, like apartment buildings or big vehicle fleets. Instead of spending years and tons of money trying to build it themselves, they just went out and bought it. Instantly, they got a hold of AI, fleet software, and more affordable chargers. Problem solved.
Next up, the cost cuts. This BLNK Forward thing isn't just a fancy slogan. They've already made moves that are going to slash $8 million a year in cash costs just from reducing their workforce. This showed investors a brand new commitment to being disciplined with their money.
And the final piece of the puzzle was cleaning up the books. They had this massive $23.5 million potential liability hanging over their heads from a subsidiary. It was a huge question mark. Well, they resolved it. It's gone. Wiping that uncertainty off the balance sheet was a massive win for investors.
And the new CFO, Berkovich, he really hammered this point home. His message was crystal clear. From now on, every single decision gets looked at through the lens of long-term growth and, most importantly, the drive to actually make money. That's music to the market's ears.
Okay, but it wasn't all good news. Let's be real here. The market is betting on the future, but there is a major challenge staring them right in the face. The cash burn clock is ticking, and man, is it ticking loud.
And this chart really just lays it all out there. The company's cash pile was literally cut in half in just 6 months, down to about $25 million. They burned through almost $17 million in the second quarter alone. So as great as the new strategy is, they have to execute it fast, like yesterday.
Now, to their credit, management didn't hide from this. They have a plan to stop the bleeding. It's got 3 parts. Keep up that awesome revenue growth, make sure those cost cuts actually stick, and get way better at collecting the money that's owed to them. It is absolutely a race against time, but at least they have a plan.
So when you put it all together, the great new strategy, the scary cash burn, where does that leave us? Let's get to our rating and what we predict for the next call.
After digging through everything, we are initiating our coverage with an outperform rating. We believe the market is going to keep rewarding the company for executing this new strategic plan, even if there are some short-term losses.
So why outperform? Well, we see 4 key things that could push this higher. First, they have to nail the integration of Zometric and launch its new chargers. Second, they got to keep that service revenue growing strong. Third, they need to prove those cost cuts are for real. And finally, we think the whole narrative around this stock has changed. People are now looking for a turnaround story, and BLNK is giving them one.
So, what should you watch for in the next report? Here's our call. We expect revenue to keep climbing, especially with help from the new Zometric products. We think the cash burn will be lower than what we just saw as the cost cuts really start to kick in. And because of all that, we think the stock will keep its positive momentum as the market rewards this turnaround.
Ultimately, the story of BLNK has shifted. It's not just about survival anymore, it's about a strategic rebuild. They're trying to pivot from a cash-burning hardware company to a lean, mean, service-driven tech provider. The big question for next quarter is simple. Can they execute this turnaround before that clock runs out? And as always, a reminder that this explainer is not financial advice.